Hello everyone, welcome to week 7 learning videos. We have 5 learning objectives today, and as usual I will be uploading 5 separate videos on them. So this one is learning objective 1. So in this learning objective we will describe the philosophy behind value investing. In short, value investing is the idea of buying cheap stocks. That is, buying stocks those market price is low in comparison to its fundamental value. While value investing appears in some instances to be logical, before we engage in this particular investment strategy, it is important to identify the philosophy behind value investing. That is, what's the explanation as to why value stocks might outperform. So value investing has been around for a very long time because it really accords with the old market adage of trying to buy stocks that are underpriced. What differs across a range of different value strategies is the question of how you can actually measure fundamental value. This is an issue because while we can observe market value of stocks, fundamental value is unobservable. So the key driver or the key explanation of value investing is the argument that there are systematic behavioral biases that affect the way investors measure the fundamental value of firm whose end result is mispricing. The key behavioral bias that tends to be identified as the driver of value investment is the idea of overreaction. It means that investors tend to overreact to growth prospects in a firm, and because they overreact to growth prospects, those firms that have significant growth opportunities tend to be overpriced. Whereas the firms that may not have such large growth prospects or growth opportunities, they tend to be underpriced because the market doesn't pay as much attention to them relative to the growth stocks. Now, as we are actually come up with identifying a value curve and trying to come up with measures of fundamental value, there is a range of different ways that investors might seek to identify value. That is, they might be looking for stocks which trades at a discount compared to book value or intrinsic value of a firm, or they might look at stocks that have higher dividend yield. This is the way of saying that market price is quite low because the cash paid out by firm is a higher ratio of that market. Or look at things like low price earnings ratios. We should note that value and growth investing are often considered to be opposite ends of the spectrum. Growth opportunities involves investing in companies that exhibit clear signs of above average growth even if the share price appears to be expensive. Growth investing is about identifying companies that are unique and going to do well in future, whereas value investing is trying to ponder cheap stocks, the neglected stocks that might be underpriced. Now, if we look at the body of academic literature as a whole, there is pretty strong case that suggests that value tends to outperform growth as an investment strategy over long time horizon. As mentioned before, that value investing strategy is not a new idea. It's been around for long years, and in fact, we can look at a statement here by Ben Graham in The Intelligent Investors in 1973, where he identifies the idea of value investing and then explicitly noting the issue of behavioral finance that actually lays out the investment philosophy that goes in line with what we discussed earlier around investors' overreaction. He says that speculative investors will buy anything at any price if there seems to be some action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, or what have you when the particular fashion is raging. Our readers are sensible investors, all are of course above such foolishness. So you can see the point from Ben Graham is that he believes that investors overreact to companies where there is some action or where there is some obvious growth. Overreaction caused those firms to be overpriced such that investors probably shouldn't investing in those particular companies, rather should be finding cheap value firms which may be a little bit more boring or a little bit less interesting, but that can result in higher returns. Now, the reason that Ben Graham's point might be particularly relevant, particularly important here, because Ben Graham was actually an academic. He is a professor of finance in University of Columbia. And one of his students in his class, Warren Buffett, who took on a lot of these principles, and Warren Buffett has gone on to be one of the most widely known value investors. Since Ben Graham, we have had the emergence of academics who have identified and studied this area of value investing, and most famous of which are Gene Fama and Ken French. Fama and French have identified that value outperforms growth across a lot of different markets and other asset classes, and their work brought value investing into the mainstream basically. But what I think is a really important quote that really summarizes the philosophy behind value investing is the statement we can see on the screen. The idea is that obvious prospects of physical growth in a business do not translate into obvious profits for investors. So to take a step backward, let's take we have a perfectly efficient market and we have two companies. One has a huge growth prospect and one has very limited growth prospect. In an efficient market, investors already know about those growth prospects, or the publicly available information should be embedded in price such that you just find that company with high growth prospects have a higher price, and after controlling for risk, the subsequent return to both these firms should be the same. But when Ben Graham arguing that in fact markets are not efficient, hence we have got that firms that has a high growth prospects got the higher market price as implied by the publicly available information. But because investors then overreact on this information, they increase the demand for those particular shares and speed up the share price even further beyond the fundamental value, such that the subsequent returns of these stocks with obvious growth prospect will actually tend to be lower because the share price must come back to its fundamental value. And on the other side of the coin, those stocks that are less glamorous with less obvious growth prospects, these are neglected stocks and they tend to be cheaper, and there may be some merit in trying to identify those stocks. Those are underpriced and you can earn some abnormal subsequent returns for doing so. So giving this idea of value investing, the question then becomes, if we were to create an investment strategy based on the idea of value investing, how would you go about doing that? There are three main approaches to value investing. The first one is passive screening. In this case, you identify screens or you identify firm characteristics or financial data that can be used to look at the ratio between the fundamental value of the stock and the market price. So basically, you are able to come up with a measure of price versus value. You will buy those stocks that have a relatively low price compared with your measure of the value of fundamental or from fundamentals, and you will sell those stocks that have a high price relative to the fundamental value of the stock. Second approach is contrarian investing. Contrarian investors are of the view that companies that have done well recently, those stocks might be overpriced because of the overreaction that we spoke about earlier. Hence, these stocks should be sold. So contrarian investor in some ways can be seen as the opposite of momentum investing that we looked at previously, but actually they are not. They're not necessarily inconsistent with each other, because contrarian investing over a long period of time, while momentum is an intermediate term phenomena. In the case of momentum, you buy stocks that have done well over, say, last year, and you hold that portfolio for 12 months and then rebalance. On the other hand, contrarian investing is long-term. It involves buying stocks that have done poorly over the past period of time, but then potentially holding those stocks for a period of 5 years. So what we actually saw when we looked at the evidence of momentum in the previous lecture is that while past winners do tend to overperform over the subsequent 12 months, there is the mean reversion over the next 4 years or so. And it's that mean reversion that contrarian investors are trying to pick up. Therefore, we could actually argue that momentum and contrarian investing are not inconsistent. They are actually perfectly compatible with each other because of the different time frames used. The longer time period is used in the case of contrarian, whereas an intermediate time period is used in the case of momentum. Next form of value investing is activist value investing. An activist value investor is an investor who will identify a company where there is a value gap. Value gap is the difference between the current value of the firm and what the firm could be worth if it was run and operated efficiently. Activist value investor come in of and engage in a hostile takeover and make changes to the business itself. So they are activists since they will take control of the business, make changes, and then seek to profit from the changes they made through improving the efficiency of the firm. That's all our discussion on Learning Objective 1. So please watch the next video for a discussion on Learning Objective 2. Thank you very much.